Welcome to the Tax Lien Training Series, Session 2. I'm Ferre, President and Founder of Tax Solutions, and this session is brought to you by TaxLienInvestorSecrets.com. This session will focus on other aspects of tax lien and deed investing to help you understand fundamental basics of tax lien investing so that we can move on to more advanced concepts. There are three primary systems used in the United States for property tax enforcement. Those three systems are tax liens, tax deeds, and redemption deeds. Now, redemption deeds is a term that we use. You may hear someone else speak of it as maybe a hybrid state. There hasn't really been an official classification for exactly what it is. But we'll give an example and help you understand exactly what a redemption deed is. But of all of these states and counties in the U.S., every single one is going to use one of the following systems here to enforce the property tax systems that they have. Now, as a quick review here of what a tax lien is, we know that tax liens are used by local governments to enforce the collection of property taxes. In other words, it's a penalty that property owners face if they are delinquent or not paying their property taxes. Now, we know that tax liens are a lien against real property for these delinquent property taxes. So the lien itself has been placed against the property, which is what makes it a good investment. Now, we also know this, that tax liens can be sold to investors to pay the delinquent taxes and fees that the county is missing up to that point. The county's really only interested in one thing, and that is collecting the money that the delinquent property owner has not paid. They count on that money to provide essential services, and by having an investor come in and pay for those delinquent property taxes, it enables them to continually provide these services even though that particular property owner was late with their property taxes. We also know that tax liens pay investors a set rate of return, and they give property owners a redemption period to repay those taxes. Now, that set rate of return can range anywhere from 10% on up to 25% or even higher. And like I said, we're looking at the closest thing to you that you can find to a guaranteed rate of return. It's something that is enforced by the state. It's written in state law, and the investment itself is backed by real property. So what that means is that the property owner may have a redemption period, which can range anywhere from 6 months to 4 years, depending on which state you're working in. However, if the property owner does not pay those delinquent taxes, penalties, and fees within that set redemption period, the tax lien that the investor holds actually could give him or her the right to initiate the foreclosure process and ultimately own the property outright due to the delinquent taxes that were not paid back. Now let's talk a little bit about tax deed states. We talked about tax lien states a little bit. We talked about how tax liens work. We know that when an individual is late in paying their property taxes, that the county will issue a lien against their property. That lien consists of 1 year's worth of delinquent property taxes along with any penalties and fees. We know that the county will sell that lien on an annual basis at a county tax sale. Now, the tax liens are fairly easy to understand. They pay out a set rate of return that is determined when the investor purchases the tax lien. They don't hold any property rights in and of themselves until the redemption period passes. Tax deeds are a little bit different. And the best way to describe exactly how a tax deed state operates is this. A tax deed state still has the same objectives as a tax lien state, and that is to collect delinquent property taxes. However, the system that they use to go about doing that is just a little bit different. Rather than holding an annual sale where they sell 1 year's worth of delinquent property taxes at a time to investors, tax deed states do things a little differently. What they'll do is they will begin the redemption period when an individual is late paying their property taxes. So instead of issuing a separate lien that they're going to sell every single year, they simply start the clock on the redemption period that that property owner has. So again, that can range anywhere from 6 months to 4 years. Now, the state will make various attempts to collect that delinquent amount, but the difference with tax deed states is that if the property owner hasn't paid that delinquent amount by the end of the redemption period, then the actual county will foreclose on the property itself. So in other words, they will handle the foreclosure process, and they will actually take possession of the property. So when a tax deed state holds a tax sale, there are some big differences in what you're actually going to purchase. So for those of you that are interested in property acquisition, this is really something to listen up on. Tax deed states hold tax deed auctions, and at those auctions you're actually purchasing tax deed properties. What that means is that you're purchasing properties that the county has already foreclosed on. So you're basically looking at a foreclosure sale. In other words, there are no strings attached to these properties. These properties have already been through the foreclosure process, and what you're actually purchasing is a deed to the property. So there is no redemption period. There is no rate of return that you're going to make on a month-to-month basis. This is just flat out simple property acquisitions. So typically with your tax deed sales, you're looking at properties that cost a little bit more or have starting bids that are a little bit higher. And part of the reason for that is rather than looking at 1 year's worth of delinquent taxes, you're actually going to be paying the total amount of the delinquent taxes that were owed, which could be upwards of 3 or 4 years plus. Now, if you consider the fact that you are acquiring a property outright, to have a starting bid that could be anywhere in the neighborhood of probably 4 to 8% of the property's actual value, you stand an excellent chance at acquiring property for a substantial amount below the actual fair market value. Now, we also know this, that tax deeds are a form of a property deed. Now, just so everyone doesn't get too confused, if you sell your home and you go to purchase a new home, what you'll receive in that situation is typically called a warranty deed. A tax deed is a little bit different, and it doesn't quite have the same rights, but really we can get into that a little bit later on exactly how a tax deed affects property ownership. Now, just so everyone knows, it doesn't mean that you cannot get a tax deed switched over to a standard warranty deed, just like you would get if you were to buy a home or sell your home. In other words, a warranty deed is one that a title insurance company will insure, which means that lenders will loan out the money for you to purchase one of those types of properties. With a tax deed, though, it's not a clean warranty deed like that. It just takes a little bit more effort in order to get it to that point. But the bottom line is you still own the property free and clear.